Ladies and gentlemen, thank you again for attending the SGX Corporate Connect. My name is Lionel, and I am from the Research and Products team at SGX. We are the team responsible for generating qualitative and quantitative content through regular market updates on a daily basis. All our published works are actually located on My Gateway on the SGX website. So, as mentioned previously, we are deeply honored to have the senior management from both Top Glove and Manulife US Real Estate Management with us tonight. This event is a great opportunity for us to have a first-hand view from the senior management on how their companies are being run. We can also glean more details into the business strategies for each of the two companies and also their future growth plans. So before passing over the mic over to the distinguished guests, do allow me some time to very quickly share with you some updates on our Singapore stock market in the year to date thus far. So given that both Top Glove and Manulife US REIT were both listed this year, I thought it would be meaningful to share with everyone a snapshot of how SGX IPO activities for the calendar year have tracked so far. So as we can see very clearly from the chart below, there were 14 IPOs in the year to date so far, and that is double that of last year in the same period. This to us is significant as it is an indication that our marketplace has picked up in terms of vibrancy and also in terms of fundraising. As we can see on the table at the top, these newly listed companies come from a wide range of sectors. Top Glove, as a reminder, commenced their secondary listing on 28 June this year. Yeah. So going into price returns, looking at their price returns, we note that these 14 IPOs have an average gain of 17% based off their initial offer prices. In fact, if we look at these 14 companies, right, they have an average gain of 5% based off their respective first day closing prices. And this number again is impressive given that it is higher than the FTSE STI's year-to-date dividend inclusive total return of 2.5%. So as you can see from the table, 5% versus 2.5%. So this clearly shows that the IPO that the listed companies this year has actually done pretty well. So now let us move on to the very quick narration on the year-to-date price performance of our benchmark FTSE Straits Times Index. So based off yesterday's close, we can see that the STI is largely flattish, declining about 1% in terms of price change in the calendar year to date thus far. The Singapore market was obviously not immune to the very volatile macro environment we have seen so far this year, as you can see from the swings shown in the chart. Well, the first month of the calendar year started badly as STI declined when global stock markets corrected due to both an oil price plunge and slowing China growth. However, markets started to rally from March as fears of a potential rate hike by the Fed in April actually subsided. Interest rates also continued to remain low, and henceforth there was a recovery in the markets. The STI declined in late April due to the three local banks, which all declined about 8 to 11% during the same period. Then in late June, there was also a very brief sell-off in global markets post the Brexit event, but fortunately, markets have rebounded relatively quickly as the impact on the Brexit was actually better than feared. So here we are today, though the index is largely flattish in the year to date. We had some swings, as we can see, throughout the first 8 months of this year. However, we would like to highlight that if we include dividend, i.e., the total dividend inclusive return, the STI actually returned 2.5% on a year-to-date basis. And this is a key point, and as it shows, our relatively high dividend yield. STI index has a relatively high dividend yield of 4%, and that helped to mitigate the minus 1% price change in the index. So now let us take a step back and we look at the longer term returns of the Singapore market. So we can see on the big chart on the top, this actually shows the 10-year dividend inclusive total returns on a Singapore dollar basis across global financial centers. So we have US, ourselves, Hong Kong, Japan, and also UK, and they're all represented by the respective benchmark indices. So this particular chart actually highlights how our stock market's 10-year total return is higher than the international average. We can see very clearly that the STI returned 66% in a 10-year period, and that is ranking only second to the Dow Jones Index in the US. But this 66% number is higher than that of the Hang Seng Index, the Nikkei 225, and also the FTSE 100. In fact, if we look at an annualized 10-year basis, our total return is at 5.2%, and that again is only second to the US markets, which is the Dow Jones Index. This is significant, and it shows how our long-term returns are much higher than some of the other major global financial centers of the world, such as Hong Kong, Japan, and the UK. So if you look at the bottom chart, right, it actually shows the average 30-day annualized volatility over the 10 years. And the STI, again, is below that of Hong Kong, Japan, and UK. Why do we have lower volatility? Well, this is because the STI is a relatively more diversified index as compared to the Hang Seng, Nikkei, or the FTSE 100. So on diversity, this slide attempts to show how our index, STI, is diverse with regional reach and how we are competitively valued with a high dividend yield. So if we all look at the pie chart on the left, we can see that the STI index is diverse in nature with representation from the 7 major sectors according to GIGS. So the pie chart on the right actually shows that STI companies generate only 49% of their total revenue from Singapore, with the rest coming from the rest of the world. In fact, I would like to highlight that nearly 40% of all companies listed on SGX are overseas companies. So what does this mean? This means that investing in STI stocks actually allows an investor to have a regional reach. We do have exposure to faster growing regions in the ASEAN regions, are also part of Asia. So moving on to the chart at the bottom, it actually shows us a comparison of dividend yields across the global financial centers. And we are comparable to the UK at about 4%, but we are much higher than the average of all 5, which is at 3.2%. We also have a higher enterprise value multiple as compared to the rest. This actually shows that our Singapore market is competitively valued. So this slide, I was touching on regional reach previously. So we would like to point out that our biggest Southeast Asia plays this year has actually outperformed the respective indices in their home country. So what do I mean by biggest Southeast Asia plays? i.e. foreign companies listed in Singapore. Yeah. So these are the 6 largest Thailand, Indonesia, and Malaysia focused SGX listed stocks. So as we can see, these 6 stocks have actually averaged a 21% gain in the year to date. And that is higher than the average of the 15% returns from the benchmark indices in Indonesia, Thailand, and Malaysia. Some of the names listed here should be familiar to us. Thai Beverage and Sri Trang Agro. Sri Trang Agro is an automobile's name. Their year-to-date performance were at 53% and 34% respectively. So both of which are higher than the benchmark index in Thailand. So other companies such as Jardine CNC, Cinemas Land, and UOA also perform impressively in the year-to-date in terms of total return. So this means that you can invest in the growth in other regions through Singapore-listed stocks. So let us now look at the Singapore stock market performance by sectors. And this is based off the first 7 months of 2016. So as can be seen from the chart, there are multiple sectors of the Singapore market which had impressive total returns in the first 7 months of the year. Let me highlight a few, notably consumer staples that returned about 23%, materials returning 15%, REITs and telcos returned about 14 and 13% respectively. Unfortunately, this was partially offset by the decline seen in the real estate and banking sectors. The key message we're trying to show on this slide is to advise people to also look beyond the benchmark for returns. In fact, there are also many other non-STI stocks out there which can generate impressive returns, as can be seen from the chart. Looking at some of the individual names by sectors below, in consumer staples, we have Thai Beverage, and Thai Beverage is an STI index component stock that did an impressive 54% year to date in terms of total returns, and followed by Wilmar, Dairy Farm, Olam, and Golden Agri. In materials, the surge in gold prices also had a positive impact on our gold mining stocks, specifically CNMC and Wilton Resources. Both stocks returned 165% and 52% respectively. Talking about REITs, interest rates globally are staying lower for longer. And what does that mean? It actually helped boost the total returns of S-REITs as investors look at yields. I would like to highlight that the average dividend yields of S-REITs, Singapore-listed REITs, is about 6 to 7%, which is very high. Singapore telcos also had impressive returns as volatile macroeconomic conditions led to a flight to defensive plays. So that's the key message of this slide, to look beyond the benchmark for returns. Lastly, at the bottom of this slide, I would like to point everyone again to our very own SGX stock facts. It actually helped us to generate this chart on this slide, and it's a very useful tool to actually view the fundamentals of the stocks on these slides. So now, do allow me to share and focus on 3 of our 6 focus sectors in the Singapore stock market. First of all, it is the consumer sector. As we can see on the chart on the top left, we can see that the total return for a consumer staples sector in the year to date has actually significantly outperformed that of the MSCI World Consumer Index, the benchmark. The charts on the right also show how our consumer sector as a whole outperformed Asia Pacific, both in the year to date and in the longer term, i.e. over 10 years. Just some of the key highlights of the sector which I would like to share with everyone. Singapore consumer spending reached an all-time high in 4Q15, and that was at about 35 billion, and that was helped by an average of 1.3 million tourists per month. Our consumer sector growth has also outpaced Asia Pacific over the past 10 years. And again, touching on diversity, 45% of Singapore's consumer sector reported revenues from outside Singapore. So one interesting trend that is coming out in the consumer space, which you all watch for, is the rise of the e-commerce space. Consumer companies are increasingly shifting their focus into e-commerce, and the likes of Challenger, having their online portal to sell their tech products. So we do see a lot of these consumer sector companies actually start to focus more on e-commerce. So lastly, one more point is our consumer stocks actually make up 1/5 of the FTSE ST Catalyst Index, and our consumer sector made up 1/4 of the world's IPO value over the past 5 years. So if we look at the table at the bottom, it actually shows 10 of our biggest and most actively traded consumer stocks, such as Jardine CNC, Genting Singapore, Genting Hong Kong, Thai Beverage, which is now the biggest consumer staples stock by market cap in Singapore now, Wilmar, Dairy Farm, and etc. So next up, the real estate sector. This sector is actually made up of real estate developers and also REITs. Well, I would just like to highlight again, Singapore is the largest REIT market in Asia, excluding Japan. We now have 42 REITs and property trusts listed on the SGX, and they have a combined market cap of over 71 billion Sing dollars, with an average dividend yield of 6 to 7%. This sector has experienced high growth, with a market cap CAGR of nearly 30% over the past 8 years. One thing I would like to highlight in this sector, something very interesting, in coming September, MSCI has already announced that there will be a new classification for the real estate sector. Previously, the real estate sector was actually lumped under financials. So now they're going to take out the real estate sector and it's going to be a new gig sector by itself. Why is this meaningful? This might have some positive impact to the sector in terms of fund flow shifts towards this new sector as institutional funds start to benchmark themselves. So we've read articles, the blue sky are talking about an incremental 100 billion of fund flow shift in, whereas some people are talking about 20 to 30 billion. Well, we can debate about the amount, but we do expect to see some positive fund flow shift into this sector. Also, we would like to highlight that on a return basis, our real estate sectors has returned 14% in the year to date, and that is higher than the benchmark. Lastly, 1 in 15 of the real estate stocks in the FTSE All-World Index are listed in Singapore, meaning that for global investors, 7% of the available real estate choices are listed in Singapore. So as we can look at the table, some of our biggest real estate stocks are developers such as Hong Kong Land, Capital Land, and CityDev. Our largest REITs are Capital Land Mall Trust, A-REIT, and Capital Land Commercial Trust. So last but not least, our healthcare sector. This sector has maintained its defensive tone in recent years. As we can see, on a year-to-date basis, our healthcare sector had a 5% total return, and that outperformed its global benchmark. We see high potential for this sector. Why is this so? Do let me share. One key point to note is that even though Asia Pacific is home to half of the world's population, the combined market capitalization of its combined healthcare sector makes up only just 1/5 of the world's healthcare stocks. So there is great potential in this sector in Asia. Lastly, I would also like to highlight that our healthcare sector returns have outperformed Asia Pacific both in the year-to-date and the 10-year annualized. So we can see from this table, some of the largest healthcare stocks are IHH Healthcare, Raffles Medical, Tianjin Zhongxin, Haopao Corp, and Top Glove. So to sum it all up, I do have a few key points. First point, Singapore stock market is resilient. If you look at the past 12 months ending July 2016, due to slower global growth, the major benchmark indices in the US, Europe, UK, China, and Japan declined 9.6% on average in returns. During the same period, the STI declined 9.5%. That's pretty much in line with the average returns of 9.6%. However, if we look at it from a 10-year annualized perspective, our 10-year annualized perspective is at 5.2%. If you compare with the average seen across the major global financial centers, they did 3.6%. This again proves our market is resilient in the longer term. Second key takeaway, number of IPO activities. The number of global IPOs for the 12-month ending July this year was actually down 20% year-on-year, with value down 40%. By comparison, based off SGX's own financial year end ending June, the number of IPOs was actually flat as compared to FY 2015. Furthermore, I would like to share that the funds raised by SGX in FY 16 was in fact up 17% to 2.45 billion Sing. Third point, takeovers. Recently, we would have seen a lot of news on takeovers and delistings happening in our local markets. I'd like to put some perspective into this. The deal value of globally listed companies' takeovers have surged over the past year. So this is something that is not this is something that is common across the whole world. That amount was at a staggering 2 trillion Sing dollars in the 12 months ending July. And this $2 trillion is actually triple that of the value 3 years ago. So although I would like to note that SGX is not immune to this trend, we would like to highlight that these delistings or takeovers only accounted for less than 2% of the overall $2 trillion. So this is a common trend, but we do only account for less than 2%. Lastly, market volumes. We all know it's tough. Slower growth in China has impacted capital flows in the region. All regional financial centers have averaged lower turnover for the 12 months ending July. Hang Seng Index turnover, in fact, was down 29% in the 12 months ending July. However, Singapore turnover value, we would like to highlight, was actually up 7% over the same period. So, to sum it all up, this chart is, so this slide says, so net, while the macro environment continues to be volatile, I do hope that my presentation has helped to highlight some of our resiliency in our Singapore stock market. Lastly, I would like to point everyone again to our StockFacts tool and also our research portal and My Gateway portal. We do have very interesting content, so do visit the website. We update them on a regular daily basis. And with that, I would like to wrap up my presentation and hand over the mic to Mr. Lim from Top Glove. For more information on our local stock market, again, I would urge everyone to visit the 3 websites listed on this slide. Thank you very much.